Welcome again to the Stepping Bricks YouTube channel. Now, today we have an interview, a special interview. We're talking about mortgages and whatever is happening in the current market. So today with me, I have Kessar Salimi.
Hi, everybody.
How you doing, Kessar?
I'm doing very well. Just happy. How are you?
Good. Thank you very much. So you are based in Scotland, right?
That's correct.
Precisely in Dundee?
Yeah.
Good. So this is a topic that I'm very interested about, which is the market, the changing market in the mortgage world. Now, lots of people, lots of property investors, of course, they generally apply for mortgages to get their portfolio, to grow their portfolio. Some of the lucky ones, they can buy just cash, they don't need these services. But let's say the majority, they need a mortgage so they can leverage their money. Now, I want to talk about what's going on at the moment with the change of government, change of inflation, change of the economy. So what's your view on this changing market?
Yeah, it's like as if you picked this timing for this interview on purpose. It's just perfect timing. So there's obviously so much going on just now. Yeah, it's very fast changing at the moment, especially over sort of the last 6 months. We've seen kind of a lot of change in the mortgage market. Rates have started to creep up, and that's really because the cost of borrowing for lenders has gone up. Often people think when the base rate goes up, the interest rates go up straight away. They don't always kind of follow in the same line. A lot of lenders get their borrowing at different rates. It's sometimes like at swap rates, SONIA rates, borrowers' deposits, so people, having savings accounts with the lenders, stuff like that. And so basically the cost of borrowing has been going up over the last 6 months. As it stands just now, whilst we're recording this, we just had a mini budget recently, and unfortunately that didn't go down too well with investors. That's kind of spooked a lot of people. That's increased the cost of borrowing for the UK government, and a knock-on effect that's had is a cost of borrowing for the lenders as well. So a lot of lenders panicked, because their cost of borrowing had increased dramatically within a week. Had to remove a lot of their products because they didn't know what to price them at. The rate that they were quoting yesterday wasn't economically viable for them today. So the good news is that they're starting to kind of find their feet a little bit now. Lenders are still lending. That's a big worry for people. Are we back to 2008? There's not going to be any lenders available, but that's definitely not the case. There are lenders there. It is quite fast paced. Some lenders are removing their products with kind of half an hour's notice, sometimes an hour. So it's very fast paced just now. But the good thing is that there is still products there. The rates are higher, but at the same time, they're not insanely high yet, to the point that it's becoming unaffordable for property investors to refinance their properties. So some good news and bad news there.
Yeah, we're kind of expecting that, right? I mean, we had probably the lowest interest rates in mortgages for ages. It was going down, almost to zero. And it was kind of expected that sooner or later was going up again.
Yeah, exactly. I mean, the cost of borrowing, over the last 10 years has been insanely low. And there's a generation of people that have never seen rates that have been any higher. So it'll be interesting for them to kind of react with these new rates and see how they get on, especially in the residential market more than, the buy to let. I think most buy-to-let investors, the way mortgages are kind of stress tested and the way we kind of stress test our properties, there's often enough rent there to cover any increase. But I think it'd be more difficult for residential people with their rates going up.
Yeah, that's true. I mean, for let's say as a stress test, generally they ask you to have at least 125% of your the rental income has to be at least 125% of your mortgage payments, right? So is that still the case?
Yeah, at the moment, I mean, this might increase in the future, but in limited company, generally it's 125%. In personal name, depending on the lender, or if you're a basic rate taxpayer or higher rate taxpayer, it might be 125 or 145%, especially if you're a higher rate taxpayer. So sometimes we find these rules annoying when you're trying to get lending, but at the same time, they're there to protect us. And interest rates have kind of going up to around sort of 6%. So, when we had interest rates that were really low, it seemed like it was unimaginable to kind of get those rates, but we are now at those rates now. So the good thing is that a lot of these mortgages have been stress tested at these rates already.
Yeah, this is quite interesting, Kesar, because a few years ago when there was Brexit first, and then Donald Trump, and then COVID, now the economy. So people were actually waiting to buy properties to get into the property ladder, and they were like scared of the changing environment. However, at that time, the interest rate was so low, they were so affordable to buy properties, that now these people are now scared now to invest in property because something's going to happen, a crash is going to happen, or a correction. So what's your view in terms of, people waiting forever to get in property?
Yeah. So this would just be my personal views. I can't give financial advice in regards to this, but you're absolutely right. There's always scaremongering, especially in the news. They're always looking for the next thing to kind of scare us with, and especially through COVID, it's definitely been like that. There never seems to be a good time to buy property, because we're always waiting for the next crash to come along. For me personally, I see it as an opportunity, and especially just now as it's been quite difficult over the last couple of years to buy properties because there's been so many investors actually buying in the property market. But I've seen things slow down a little bit. Some people are worried. For me personally, I see it as an opportunity. So I've been going out viewing properties. I think there's less competition just now. So for me personally, I see it as an opportunity. And overall, I'm looking at property investment for the long term. If it fits the numbers now, you can never really time the market 100%. But if it fits your numbers, and especially the way inflation is just now, if you're sitting with that money in the bank, it's ultimately eroding with, at kind of whatever rate they're saying. And even that is kind of manipulated depending on which figures they use. Sometimes they kind of include certain types of commodities and they don't include certain other ones. But for me personally, I'd rather have that money invested in property rather than it sitting in the bank.
Yeah, that helps you a lot because you're a property investor first and then a mortgage advisor later. So it helps you a lot because you have your hands in the game. So it's your best interest to learn more about the game and the rules of the game so that you can benefit as well from whatever situation is going to happen. So that puts you in a very good position, because you can access as well, all the changes in rules for the mortgages, for mortgage lenders, sorry.
True.
Right. So let's talk about differences between Scotland, England, Wales. So different in the UK, we have different lending criteria and different lenders as well. So can you summarize more or less what's the situation in different countries?
Yeah, I mean, generally the rules are similar in regards to kind of lending products. The same in Scotland and Wales, sorry, England and Wales. In Scotland, it's slightly different. Unfortunately, some of the lenders that lend in England and Wales don't lend in Scotland. The reason being is that one, the legal system's slightly different here. And certain lenders, they just don't feel that, there's enough business up here to be worthwhile for them lending. So it's not like they don't like Scottish people, but they just don't feel it's viable for them. It's quite a small place, population-wise. There's less population here than there is in the whole of London. So, it's not a big market for them. So what that means for property investors is that we've got a smaller pool of lenders that will lend to us. So it's been growing over time, and especially over the last couple of years, a few new lenders have introduced themselves into the Scottish market as well. I think in the future we might see even more lenders, sort of across the border as well and start to lend in Scotland. Especially in limited company now, it's much better than it was even sort of 2-3 years ago. So although we've got less lenders than we have in England and Wales, there's still a decent amount of lenders available to us now.
Okay, so now let's explore different situations in terms of personal and financial background. So let's say for a person that has a job and has a salary, buying property in their own name, of course, is quite straightforward. When it comes to self-employed, then the funny things start.
Yeah.
But the reason why I'm asking this question is because a lot of training companies out there, they say, oh, quit your job, quit your 9 to 5 job, as they push on emotions, and then people actually quit their job before even have a plan, on how to invest in property.
Yeah.
So what happened when you quit your job and when you're self-employed and you don't have those 2 years of tax returns?
Yeah, it's a great question. Some lenders want you to earn a certain amount of income, especially sort of the high street lenders maybe want you to earn 25,000 income from an employed position, or if you're self-employed to then actually be having sort of 25,000 of rental profits at least. And especially in the first few years, you tend to be sort of renovating your properties, so you tend not to have profits of that level. But the good thing is that buy-to-let mortgages are assessed differently to residential mortgages. Generally, they're assessed on the rental income that the property will achieve and the value of the property. So we talked about the stress test earlier on. When the surveyor goes out and values the property, they'll also come up with the rental figure that they think the property rent out for, and the lender that will punch that into their rental stress test. And if it fits, then they will lend. So there is many lenders that will actually lend with a no minimum income. However, usually they want you to be an owner occupier or an experienced landlord. There is a few lenders that will do it, where you are a first-time buyer, and a first-time landlord. However, the risk for them is that because it's done on a rental basis, they're worried that you might end up moving into that property yourself because you won't be able to fit the affordability checks if you was going for a residential mortgage. But ultimately, if you did decide to give up your job and become a full-time property investor, you don't necessarily need to earn a minimum amount of income. Generally, what the lenders be looking for is to make sure that you earn enough to cover your outgoings. So they don't want to see your bank account sort of depleting each month and you're not earning enough to kind of cover, your general day-to-day expenditure. But you don't need to earn a minimum amount of money to be able to get a mortgage for a buy-to-let.
Yeah, that's good news. That's good news. So before you quit your job, just make sure you have a plan and you know what you're doing, and then you can do a slow transition rather than just quit and then you don't know what to do. So when we go in certain limited companies, the rules change a little bit. So okay, let's take one step at a time. So how easy is to apply through a limited company? And then we go to the next question, which is portfolio landlords. So when you have both, it doesn't matter where you buy, if you buy in personal name or limited company, the lenders want to have the full portfolio for their assessment. So first question is, how easy is to apply through the limited company?
Yeah, it's very easy actually. And a lot of people think that you need to have this company open for a certain amount of years to be able to get lending. You can open up the company today and be able to get lending straight away. The way I view it in regards to the mortgage process, I mean, from a legal and a tax point of view, it's completely different. But from a mortgage point of view, it's really just like applying for a mortgage in your personal name, and it's just in a tax wrapper. So let's say, for instance, it's just you, Giuseppe, that's applying as a limited company director and shareholder of that company. They'll be still assessing you in regards to the application, still doing the credit check on you, looking at your income and stuff like that. The benefit of that, though, is that you can get lending from day one as well. One of the downsides, though, is that generally in a limited company, you've got limited liability when it comes to from a tax point of view. However, the lenders will want you to sign a personal guarantee yourself as well, so you're ultimately liable for that mortgage, even if the company goes under.
Yeah, that's true. And I've seen so many posts online saying, oh, they're asking me for a personal guarantee. Well, the alternative is that you don't get a mortgage. So depends what you want to do. So the other question was, once you have a number of properties in the portfolio, whether they are in the limited company or your personal name, the lenders will ask you, I'm talking by experience, they will ask you to pull all together in one file all the properties owned in your name and the limited company, because they're going to assess the full portfolio. So you're a portfolio landlord, whether you apply for a personal mortgage or a limited company mortgage. So what are the downsides or upsides of these things?
Yeah, so it was the Prudential Regulation Authority that brought these rules out. Who once you've got 4 or more mortgaged buy-to-lets, so if you've got ones that own cash, they don't get included, but if you've got 4 or more mortgaged buy-to-lets, they class you as a portfolio landlord. And what they then need to do at that point is start looking at your background properties. And really what they're looking at is just to make sure that they are actually cash flowing well. So are the loan to values kind of sitting at the levels that they like? And every lender's got their own criteria, but generally sitting around sort of 75% loan to value. Are they fitting the rental stress test, like the stress test that we discussed earlier on? In the past, especially in, like, say, the southeast of England, where property prices were increasing, say 100,000 a year, you was able to just refinance that and take that back out. But now the lenders, need to kind of check on the background portfolio to make sure, is it actually cash flowing positively? So some lenders don't offer mortgages to portfolio landlords because there is additional work involved for them to, because they're not just checking the current mortgage application, they need to check the background ones as well. But however, there's plenty of lenders that will. So don't let that put you off. There's a little bit more work involved, but especially if you're using a mortgage broker, they'll help you with that. Generally, it's just like a spreadsheet that you need to provide with a list of your properties, how much they're worth, how much they're renting out for. Sometimes they might ask you to produce like a business plan and stuff like that. But again, it's usually very basic. It's often kind of pre-populated by them, and you just need to tick a few boxes like what you're looking to do, what's your goals and so, over the next sort of 12 to 24 months. So a little bit more work involved, but at the same time, it's not a deal breaker. It's not like you can't get lending once you become a portfolio landlord.
Yeah, that's great. Thank you. So one last question is about investors. Now, many people don't have the cash to buy properties or to get mortgage, so they rely on JV partners. JV partners can either be part of the title deeds or just people that are lending money. So let's see this second scenario where you get people, they lend you money and you give them an interest back as a return. How is the lender going to see this money coming in the bank account?
Yeah, it's a great question. So generally, if you're looking to get a buy-to-let mortgage, they'd want those funds to come from your own money. So usually that's either savings or a gift. And if it is a gift, it's usually from like a close family member. If you're using like an investor finance or a JV sort of partner, usually that would either be to buy the property outright and then you maybe look to refinance that to pay them back. Or it might be like on short-term finance, like bridging finance. A lot of bridging lenders will allow you to use like investor finance to fund the purchase or partly fund the purchase and the rest to come from them. But if it's a buy-to-let mortgage initially, they typically be looking for them funds to come from you. On the refinance, it really depends on what sort of scenario or how you set that up. If they've taken a charge over the property, the lender will be able to see that. And it's just really speaking to your broker at the time and just discussing all the options, making them aware up front, how you funded the purchase initially as well. Because some lenders will also check how you funded it for the refinance. And it's speaking to the right lenders. Some lenders are comfortable with that, some aren't. But generally, there are options available to you if you did use an investor or a JV.
That's been great. Thank you so much, Kessar. So so the final message here is speak to your broker, somebody you trust, and then they will be able to help you with your situation, because there's no one size fit for all. So you have different situation, different background, different salary, different income, different area where you want to buy a property. Even the same person with different properties has different situations with the lenders. So always rely on a good broker, and they can help you out with your property investment journey. Thank you, Kessar. Do you want to say anything else to our audience?
Maybe just a quick plug for my business then. First of all, Giuseppe, thanks for having me on today, and to the viewers as well. I hope this was valuable content for you guys. For myself, I've been a property investor for over 12 years now. I do sort of BRR strategy predominantly, and in regards to our clients, is what we help our clients do as well, is to grow their portfolios. The majority of our clients are property investors, and that's kind of the market that I've niched in. So yeah, thanks for listening to me today.
That's good. We're going to put your contact details down in the comment below so people can get in touch with you directly. Okay, thank you very much, Kessar, and thank you for listening, guys, and I'll see you in the next video. Bye-bye.